Welcome to the Chamber Music Mindset. I am your host, Anna Rathbun. We have a lot to cover today. It was an exciting week. Every week is an exciting week because there's always stuff going on in the markets, and the markets and the economy never sleep. Before we start, a reminder that nothing you hear in this video is investment advice and that everything is for discussion and for information purposes only. Okay, let's get started. The S&P 500 was up last week when it was all said and done, but it wasn't without volatility. Actually, S&P 500 sort of melted up, and we use that term in the markets, melting up instead of melting down, because it just slowly drifts up. But small caps actually had a lot of volatility. And it ended the week in a positive territory, barely. It was pretty much flat. But it kind of goes against what I said last week about small caps doing really well. It turns out maybe that had been a fluke. I don't know. But there was definitely some variation in market performance between large cap and small cap. Here are some big market movers. Naturally, because we are anticipating the Fed to be deciding on policy this week, everything leading up to Friday and into this week had been inflation and jobs numbers focused, because the market is wondering, what is the Fed going to do? So the big market movers were relevant to inflation and to employment, and we're going to talk about that a little bit later in the video. Now, I have been asked by a lot of people, you keep saying that interest rates move the markets. Why does it do that? You got to think of it in two general ways. There are many, many reasons why, and they could be stock specific as well. And then we see it as observers of the markets in terms of the S&P 500 movements and small cap movements, etc., in terms of the market. But sometimes it's very, very stock specific. Think of it in two ways. Interest rates are borrowing costs for anybody. It's for you and me too. But if we're talking about the stock market, it impacts the borrowing cost of the corporation. And so when the borrowing costs go down, you can imagine executives can decide to borrow more or more cheaply, whatever they may be borrowing for. It increases the liquidity and perhaps the activity and potential future profitability of the company. So all of this is sort of secondary, tertiary, and way out derivatives of good things about the markets. So interest rates have to do with the direct impact on the borrowing costs for the company and potentially future activities. The other thing to think about, more general in terms of the markets, is the question of where is the fair price of the markets? Sometimes I say that the market is very expensive. What do I mean by that? Where is the reference point, right? And that reference point really moves around depending on the interest rates. So things like, and I won't go into the actual formula for, discounted cash flow models and things like that. That's not for this video. But all I'm going to say is that the interest rate actually has an impact on what the fair value of a stock is and what the fair value of the stock market is. So when interest rates go up, the fair value comes down. When interest rates go down, the fair value goes up. So if the fair value of a company or the markets go up and we're already expensive, then that means we're not that far. If the stock market isn't as expensive as where the fair market value is, but when the interest rates go up and the fair market value goes down, then suddenly, the markets are so much more expensive. I know that was a lot more, maybe more than what you had bargained for, but there is this mechanism in the investors' minds and traders' minds about what kind of impact it has. Some of this is perception. There is no way we can know for sure where the stock market should be. Most of the time, it is not where it should be, this theoretical fair value, but certainly the interest rate movements have an impact on the perception of how expensive the market is. So Interest rates coming down lowers the borrowing costs for in a real way, right, for companies, but a more conceptual way, it actually makes the stock market less expensive than where it had been when the rates were higher. That's a more conceptual, perception-based rate impact on the stock market. That may have been too much. Let's move on. Okay, there are two corporate events that I want to talk about. There are a lot of things happening in tech, and so I know I tend to talk a lot about tech, but frankly, that's where all of like the crazy, movements in stocks are coming from. And this week it was Oracle. Now, Oracle was this, it's in every one of our lives, but it's a little bit in the background. It's not like Nvidia where we're talking about it almost on a daily basis or a weekly basis. But Oracle made a splash last week. Oracle is a cloud infrastructure company. What's crazy is, the stock went up, double digits and ended the week when it was all said and done. I think it was up about 35% when it ended the week. And it made the founder, Larry Ellison, the most wealthy man above Elon Musk for a little while, while the stock was really, really high. What drove the stock? Well, it wasn't earnings, because it actually didn't beat expectations on earnings, but it had everything to do with AI. By now, you should probably know that AI tends to move the markets in a big way. Oracle pointed to a demand surge for its cloud computing, cloud services for AI related firms. So we're not talking about chips here. We're not talking about the software companies that are utilizing those chips to develop software, which are not quite all the way reliable yet I can say, for the entire AI industry. But we're now talking about cloud infrastructure, which is also sort of adjacent to the actual AI play. This is sort of like talking about how there's going to be more demand for energy because of all of this demand for AI and development of AI. So there are two things here. Oracle and Google Cloud came to an agreement, struck a deal for Oracle to sell Gemini models. Great. OpenAI and Oracle also deepened their relationship. So there's a lot here with regards to AI. So it didn't matter that Oracle actually missed earnings. This was all about AI and the future of AI. It had nothing to do with the past. The other thing was Klarna IPO. Klarna, if you're a shopper, if you're an online shopper, you probably have seen the name Klarna appear when you're about to check out, because Klarna has been offering buyers an opportunity to break that up. You could pay for this purchase in 4 payments. This is sort of the buy now, pay later type of a thing that I've been talking about. That's not quite debt, but it kind of is. Now, Klarna IPO'd. It was a private company for about 20 years, and it IPO'd, and that made a big news. Now, what was refreshing about this was that it wasn't AI for once, but it definitely made a splash because it touches all of our lives at the individual level. Like I said, if you're a shopper, you would have seen it. You're going to continue to see it, and they're actually expanding their business into the consumer base. So Klarna is probably going to become a household name. So those are the two stocks that were very, very notable last week. One was definitely a market mover, made a splash, but all in all, it was a positive week for the S&P 500. Much of it led by a lot of these bigger tech companies. Unfortunately, it wasn't the same story for small cap stocks. And I think that's going to have an impact coming up in the rest of the year, because small cap stocks, small companies are closer sort of to earth and closer to us. So we'll see what the rest of the year has in store for the markets. Okay, the markets are in anticipation for the Fed policy meeting this week. If you're around on Wednesday around 2 p.m., and you remember too, you can watch the markets for a really entertaining movement. Usually in the mornings, the markets are usually flat because it's waiting for the Fed announcement. And around 2 p.m., the policy comes out. Right after 2 p.m., there's a knee-jerk reaction to it. And then the rest of the afternoon, there's this digestion of the details underneath that headline policy, as well as what we learned from Fed Chairman Powell at the press conference. Very interesting day. Now, we'll talk about what we learned last week with regards to what we think the Fed might do. Okay, so this is all anticipatory. So inflation, we had both PPI and CPI come in. PPI, which is the producer price index, is a measurement of the price changes experienced by businesses. PPI came in negative print for month over month. I think both core and headline was 0.1% cut. And then for year over year, 2.6% increase for headline and 2.8% increase for core year over year. These numbers were lower than what we experienced the month before on a year over year basis. So all around, great PPI. Goods prices where tariffs are actually impact is felt, it actually rose by 0.15% month over month. This isn't like a skyrocketing number, okay? It is still like increasing. This is a fourth consecutive month of increases, which means that, yeah, there's some tariffs increase in price actually in there, but in the aggregate, it's not making a splash. What is interesting is that there was a deflation in services. So remember, tariffs are levied on goods, not on services. So it's very important to watch services, because if we start seeing inflationary, impacts on services and we feel like it's spilling over into services, that has implications for actual inflationary pressures that the Fed would worry about. But services fell. Prices were cut by 0.2% on a year over year basis. And that's like a huge slippage since last April. And before that, it was at 2020 when the pandemic was starting. So this is actually really, really good news on the producer price index front. On the CPI side, it actually wasn't important enough to move the markets up or down because CPI itself didn't move in a significant way. Now, you have to remember that this doesn't mean that the Fed cut is guaranteed, because CPI still came in higher than the Fed's target. Okay. But you can actually say that on the inflation front, on the tariff front, there wasn't a huge impact. So that's actually good news. On the employment side, jobless claims rose from 236,000 to 263,000. This actually, on the surface supports this idea that the labor market is slowing down. We've actually seen these numbers for a while, so it's not surprising. But this particular number, I wouldn't worry about it too much, because this number changes week to week, and there's a lot of noise in higher frequency numbers. So I would take that with a little bit of grain of salt, but it certainly didn't help the sentiment around the weakness in the labor markets. Now, one thing that isn't a direct impact on the Fed, but I know the Fed is watching, if I were a Fed official, I would be watching, is consumer sentiment. On Friday, we received the University of Michigan survey coming in. It slipped from 58.2 the month prior to 55.4. This is a big slip. It's indicative of a real deterioration in how you and I feel about economic prospects. And it's not surprising, because the labor market has not been giving us good numbers all around. It's a weak labor market, and that has prospects on it has implications on what we think our employment prospects are, and that can make us feel good or bad. Now, why would the Fed care about this? Because this is a little bit removed from direct data, but if we don't feel like labor market is strong enough for us to, if we lose our jobs, we can find another one, or we can move on to a different job for better earnings or better career prospects. If we don't feel positive about the employment market, then we tend to spend less on discretionary items. And that has, if enough of us do that, and that actually, spills into the bigger, aggregated into the numbers in the economy, that actually has impact on GDP. It has impact on corporate profits, all of those things, right? So consumer sentiment is very, very important. Now, it is 1 month falling. It's indicative of how I feel right now, but let's take a few steps back. The long-term median for the UMich Consumer Sentiment Index is 82. 55.4. It is far below 82, the average. But it's been below this average for a long time. So going back to 2021, we reached that average for a little bit, for a few months, because suddenly we were able to leave our apartments and leave our homes, and we were out of the lockdowns and we can move about. Remember, like revenge spending? Remember that? It impacted our sentiment. So it was up to average for a little bit, but before that it was below. During this time, if we take out the 2021 let's get out of the house sentiment increase, we actually hadn't seen a number this high since before the pandemic, and it was higher by so much more. So I wouldn't take this 55.4 really seriously, because we've been, trudging along below 82, below the average for a long time. And so this isn't a sudden shift that we should be worrying about. Okay, finally, my thoughts on what the Fed should do. I think the Fed should cut because is there a reason to be restrictive at this point? If they're neutral, they're telling us the neutral rate should be 3% and they're above 4%. What's the reasoning behind that? Especially when the labor market is deteriorating, right? And their policy for price stability is exactly that. It's price stability, and it has been stable around 3%. Yes, it is above their 2%, but maybe it's time to, revisit that 2% target. The question in my mind is, and this is a little bit of a bigger question, if we're trying to get inflation down to 2 when it wants to be at 3, are we strong-arming inflation to go down? Does that mean, how does that work mechanically? That means that businesses have to lower prices, and we have to like those lower prices, right? Who wouldn't like lower prices? That means that businesses are actually competing for your business because we're not buying it anymore, right? That is more of a sort of a recessionary color. So what are the consequences, maybe unintended consequences of strong-arming inflation down from 3% to 2%? I don't want to find out, okay? So that's why I've been calling for the Fed to actually not cut as in the sky is falling, but let's start this normalization process again. They started last year and stopped. Let's start the normalization process again and getting it down to neutral. It doesn't have to be neutral tomorrow, but maybe we should start on the path toward it. Okay, that is my opinion on the Fed. All right, exciting week coming up. Certainly there's the Fed. Like I just talked about, we have a lot of data on housing, and of course the housing market and interest rates are indelibly linked, okay? And then there's a lot of industrial production numbers coming in, capacity utilization, all of those things. You don't have to worry about that. If they're important, I'll talk about it next week. And there's also retail sales. I just talked about consumer sentiment, spending, and the impact on spending based on the prospects of employment. All of those things are connected. And so retail sales is going to be very important. Not only for this week coming out, but certainly weeks, months going forward as these tariffs continue to be negotiated. All right, have a wonderful week, and I will talk to you next week.